right? Like I think in general, if you go to like most top tier VCs and you say, hey, wouldn't you like more, everyday type people to have access to your funds? Most of them would say yes, right? But they just don't want to deal with the hassle of it. So the fact that we're able to make that hassle free for them, I think the mission has also been quite appealing.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have John Bailey with us. John is a co-founder at OneFund, where they are increasing access to alternative asset classes. In this episode, we talk about how OneFund got started, making venture capital and private equity a more accessible asset class, increasing awareness about PE and VC investing, how investing at OneFund works, what is private equity and the different stages of it, what are the return expectations in private equity and VC investing, and a lot more. So without wasting any time, let's dive straight in. Hey, John, so good to have you on the VC 10X podcast. How are you doing?
I'm good, Prashant. It's great to talk to you. Like I said earlier, I've been listening to your podcast all week, and I'm really excited to be talking to you.
Yeah, it's my pleasure. Went through one fund investment, and it's again something pretty cool that's happening in the industry and something that's very needed. So before we get deeper into it, can we have your story and why you started OneFund Investments?
Yeah, absolutely. And before we dive in, I guess I'll just plug some of the other episodes that you've had. I saw, you interviewed Daryl Frater and Jason Kirby, both people that I've talked to, and really great listens. So people should check those out, and I'll plug those guys' stuff. But yeah, so I started OneFund Investments with my co-founder quite recently, within the last year, actually. I spent the first few years of my career at General Atlantic, which is a pretty large growth equity fund based in the US, but they invest globally. And while I was there, I think I got really exposed to the amazing benefits that private equity and venture capital can offer to investors. And you know what I mean by that is like just generally historically really strong returns, right? Adds a lot of diversification to a portfolio. If you think about it, the majority of US companies are privately held, right? So most everyday investors, if they're investing purely in public equities, you can have as diversified a portfolio of public equities as you want, and you're still not exposed, have no exposure to, and by some measures over half the economy, which is privately held, which is just kind of really interesting and mind-boggling to me. And then additionally, the stability of the asset class, I think is really strong. And a little bit of that, I think, can come down to, some discussions around, hey, it's only marked once per quarter. But at the end of the day, when you look at valuations of privately held companies, they're more stable and less volatile over time. So yeah, just seeing sort of these fantastic benefits that it can offer. And then realizing, well, almost everybody who's invested in this asset class, right, is a very wealthy institution or high net worth individual, right? It's a lot of university endowments. It's a lot of people who made their significant amount of money through real estate or founding other companies. And as somebody who worked at one of these funds who was relatively knowledgeable, I was started looking like, hey, well, how can I get invested? And realized it really wasn't possible for somebody like me to invest into top tier funds, and started looking around and wasn't totally satisfied with some of the options that were out there. And we can talk about how the industry at large has, because there has been some attempts to solve this, right? There have been some attempts to, okay, how do we take private equity and venture capital and make it more accessible to more investors, in most cases accredited investors? But just kind of looking around, a lot of the options didn't really appeal to me. So I started talking with a buddy of mine who's now my co-founder, Spencer Moslow, and he was the former co-head of investor relations at a hedge fund. And we were both sort of like, yeah, like this is a real, like he immediately got it, right? And was like, yeah, this is definitely a real thing. Like I can't invest, he's the co-head of investor relations and he couldn't invest in a lot of different alternative assets. And we kind of started, in the early stages of market validation and felt that we were onto something and got started down this journey of building OneFund, which is really a marketplace with the goal of connecting top tier general partners, PE and VC funds, with accredited investors who want access to them.
Exactly. Yeah. And like you said, it's like a very restricted kind of asset class that not a lot of people who want access, or maybe even talking before that, like a lot of people are not even aware that this asset class actually exists and this offers better returns than the traditional asset classes. So, are you doing something to increase that awareness and then put this offering in front of them?
Yeah, I think that that's definitely one of the challenges in the industry in general, right? PE and VC investing, while it can be very, beneficial for those who are invested in it, it behaves very, very differently uh, to public equities, right? There's lower liquidity. There are capital calls. The return profiles look extraordinarily different, right? Most VCs might make an investment and the valuation might hold flat for over a year until there's the next funding round, right? And if people aren't aware of that, it can be confusing. It can be frustrating. And so a lot of what we're trying to do is around education. Whether it's, we've had interviews with a lot of really great VCs talking about what they do and their VC funds and how they invest. And then additionally, we've had trying to do like, McKinsey, Bain, Fidelity put out these amazing reports every year that are like 85 pages long, right? Like nobody's reading that unless you're very involved in the industry. So we try to sort of like condense it down and say, hey, here's what, McKinsey thinks about the private equity market, for 2022. Here's some of their lookouts that they're concerned about. Here's some of the things that they're excited about. And try to be very transparent, I think, of taking some of these, really amazing companies and research that they do and distilling it down, making it a little bit more digestible. And we're definitely going to be trying to do more of that going forward, right? Just giving people general information about how this space works. And so we'll continue to develop that there. But I think it's been really well received and just generally really helpful to people.
Yeah, absolutely. And talking about increasing access, one more aspect to increasing this access can be that to get into this asset class, it usually requires that you invest a big amount of money at once into a VC class or maybe a private equity firm. Is that also a problem that you're trying to solve so that we can get more people to invest in this asset class by reducing that threshold?
Yeah, that's a really, really critical problem. And honestly, one of the biggest impediments, right? There are other impediments that you do need to streamline from a technological standpoint, like ease of the subscription process. And by that, I mean, when you find a fund you actually want to invest in, how do you make that process smooth for a retail customer? And so there's a technological component that you have to solve. Um, but that minimum check size is enormous. I'll tell a kind of like funny story when I think I realized that we were potentially onto something here. I was talking with a senior MD working in investor relations at a large PE fund, and they had something like a $10 million minimum investment requirement, which is huge, right? Unless you have hundreds of millions of dollars, it doesn't make sense to really invest in that. And I was telling him about what we were thinking about and the problem we were looking at. And he was like, oh, we're going to try to move retail too. We're cutting our minimum investment from $10 million to $5 million. And I was like, okay, that's great, but $5 million is not exactly like retail accessible, right? Okay, great. Now instead of having to have $100 million to invest, I only need to have 50. It's not. It doesn't really like move the needle for most people. Which so I think it was like very validating that hey, the desire is there from a lot of top funds. I think to take more retail investors or make their returns accessible to more people, but honestly, they shouldn't be building out the tech platform that's needed to do that. Right. I have a strong belief that PE and VC funds can only be great investors if they're spending the majority of their effort investing. And just the requirements to build out a tech platform like that, it just really wouldn't make sense for them. When you think about like how the industry as a whole has worked around solving this, minimum, these like high minimum investment requirements that are needed in the industry, I think there's really been three approaches to it. The first is sort of the direct investing, whether it's the angel list or the republic model, where an accredited investor who wants to put five, 10, $100,000 into like the venture capital asset class can go on to AngelList and either join a syndicate or pick individual startups that they want to invest in. And I think that model is really interesting, but some of the disadvantages to that is, honestly speaking, most people probably should not be picking the individual startups that they want to invest in. It just gets very messy, right? You need a lot of time to appropriately due diligence. Honestly, it's helpful to have a lot of experience as well. And it just sort of like compounds the risk factor there at the early stage. And you're not as diversified. You just won't have access to as many deals as you would if you were investing in a fund. And then there's been some really interesting like industry developments around some VC funds that are structured differently so that they can accept lower minimum investments. Like they are basically building out that tech platform, right? And some of them go quite low in terms of the minimums that they'll accept, like 3 digits, like in the hundreds of dollars even. And I think that's fantastic. But some of the obstacles or hurdles there is that a lot of these VC funds have no track record, right? They're brand new. They've kind of just sprung up. So they don't have a history of investing that you can look at to see what their historical returns look like. And you're also limited to one mandate, right? You're only investing in one fund and in one particular VC fund, not OneFund, the name of our company. You're just investing in one particular VC fund, which is great if you're worth, hundreds of millions of dollars and you can invest in, 5 different funds with different mandates and investing in different geographies at different points in the private company life cycle. But when you're limited to this universe of just the few VC funds that are out there that are accepting early stage investments, it's a little bit more limiting. And then also you fundamentally just don't have access to, larger scale private equity, buyout, credit, the whole other suite of alternative investments that we haven't even really scratched the surface on. But I think this third model that we're pursuing that I think is a bit quite interesting is this idea of building a marketplace, right, where existing VC and PE funds that have track records, you partner with them to go on your marketplace where your members can find them and select which offerings they are interested in. And that way, I think there's a little bit, when you're investing in existing PE and VC funds, there's a little bit more peace of mind of, hey, I know where, I know what they've invested in the past. I know that they have a track record. And I know, what their strategy is, how well they stick to it, et cetera. And there's a lot of benefits there, in my opinion.
Right, absolutely. And these people who are investing in these VC funds on the OneFund platform, are these going in as single entities on the table of these VC funds, or are they going in as the name of OneFund, wherein all the people who are interested to invest in that VC fund are grouped together as a single entity, and then they're investing in that VC fund? So how does that work?
So that's a good question. So on our platform, and this is part of how we're able to appeal, I think, to GPs, is that OneFund Investments operates for our GP partners as a totally normal limited partner. So OneFund Investments becomes the limited partner into the GP, into the VC or the private equity fund. And then our members invest in, our independent funds. And so part of the appeal of what we're trying to bring to GPs, right, is we go to GPs and we say, hey, we bring you completely incremental capital that you wouldn't otherwise have had access to. It doesn't cannibalize your existing fundraising efforts because of the type of people who are using our platform. And we're no additional effort for you than any other limited partner or investor in your fund would be. And I think when you combine that with the fact that there is a good mission behind this, right? Like it is a story that people feel good about, right? Like I think in general, if you go to like most top tier VCs and you say, hey, wouldn't you like more, everyday type people to have access to your funds? Most of them would say yes, right? But they just don't want to deal with the hassle of it. So the fact that we're able to make that hassle free for them, I think the mission has also been quite appealing.
Yeah, it seems like kind of following an angel syndicate model that is applied to the VC firm model, wherein all these individuals come together and under a single name, they're investing into a VC fund now. And on the angel syndicate, they're investing in startups, but here they're investing in a VC fund, right? Is that a good comparison?
I think that's a great comparison. We're kind of building an angel list of for VC and PE funds in particular. And what becomes really interesting, I think, about just the broader industry as a whole, right, is so often I think the conversation focuses around VC and to a certain extent PE because I think like they're sexy, right? They're like the most coveted asset class. But there are so many alternative investments out there that are really important towards for a diversified portfolio, whether you're talking about credit, infrastructure, growth equity. We mentioned a little bit, which is kind of the lesser known brother of PE and VC, but kind of equally important to that diversified alternatives portfolio. I think we have the ability, if we want to do all of that, the way that we're building this. Fidelity's put out some really interesting research recently that kind of shows like like as part of like a multi-asset class portfolio that somebody might have, right? Like stocks, bonds, maybe you have a little bit of real estate. If you're able to add alternative investments into that, it actually like it has a fairly significant increase on your risk adjusted returns, right? So this like ability that like, hey, if you're able to add in alternative assets and different alternative asset classes to get your portfolio as diversified as possible, you actually have higher risk adjusted returns, which is like insanely powerful, right? Like that's what everybody's chasing in finance. And I think up until fairly recently, and a lot of the changes that have been happening in the past couple of years, that has really been reserved for, like we mentioned earlier, very wealthy institutions and individuals. I think most university endowments, like the University of Texas endowment, Harvard endowment, have like 15 to 20% of their assets in private equity and venture capital, perennially. And I think that, these like very, very large multi-billion-dollar institutions have figured out that, hey, this is a way for us to raise, build the nest egg for the university. I think it's very exciting that we're approaching a point in time where increasingly accredited investors, more retail investors have access to this stuff.
Yeah, absolutely. And we talk a lot about the venture capital asset class on this podcast. And one asset class that we don't talk about is the private equity asset class. And I know that venture capital is actually a part of the private equity asset class, but equity is just a broader asset class, and it goes a lot beyond, because venture is mostly focused on early stage investing, and private equity goes much beyond that. So can you throw some perspective into the private equity asset class, and what are the return expectations, and when it actually comes into the picture, at what stage in the company?
Yeah, absolutely. That's a great question. I think a lot of the times people don't, to your point, don't realize that venture capital actually kind of falls under this broader umbrella of private equity. And a lot of times people who work in what we call like buyouts, which would be sort of like late stage private equity, they just call it private equity, even though it's really like this pocket underneath this private equity umbrella. So there's really kind of like three stages to private equity. And all it means when we say private equity, right, is it is companies who buy equity in privately held companies, and that can be at any stage in their life cycle. So venture capital is sort of like your pre-seed to, and these are kind of loose boundaries. There's obviously everything kind of bleeds over, and the devil gets in the details. But venture capital, you're talking like pre-seed to sort of like Series A, maybe Series B. And these are people who are investing in high growth, scalable companies. Venture capitalists are are looking for companies that they think are going to be the next Facebook, right? The next Snowflake, um, the next Microsoft. They're trying to find companies that they think have great teams, good growth potential, um, and maybe they haven't even found product market fit yet. Maybe they just have like an amazing technology and they're trying to figure out a way to leverage it. And the typical strategy of VCs are to place a lot of small bets, right? You want to have, because there's a very good chance at the pre-seed to Series A stage that a company could go under. So you want to have as many bets as you can. And this is another point to what I was talking about earlier with AngelList, right? Like if you're investing individually into startups, that's fantastic. But unless you have the experience and the time, you really need to make a lot of bets to try to have a well-diversified basket. And like we're talking dozens and dozens, even hundreds in the cases of many VC funds. And they're betting that, a handful of their companies will launch off and become unicorns. And that's where they derive the majority of their returns from, typically. And then you have kind of like growth equity. And growth equity kind of sits in this like interesting spot between venture capital and buyout private equity. And they're typically buying General Atlantic, the company I used to work at, is one of the larger growth equity shops. There's also, Insight Partners as well, and a few others. And they're trying to buy, kind of like post VC, once a company's matured and scaled too much for a VC to be interested in, they're going in and typically making like minority investments. So buying, 10, 20, 30, 40% of the company, and trying to really accelerate growth, right? They're interested, as the name might imply, high growth companies with top line growing 20, 30, 40% a year typically. And they're really trying to take that company from a point where it has product market fit, really strong sense of who they are, and trying to scale that as quickly as they can, whether that's through international expansion, building out additional products, et cetera. They're trying to take your, 20 million ARR company and turn it into a 200 million ARR company. And their investments are typically a little bit more stable than VC, right? Because you're building off of a more stable base, right? VC fund might be investing in a company that has $200,000 of ARR. Growth equity is coming in at like 20 million, right? So typically there's lower loss ratios in growth. It's a little bit safer, a little bit more stable, and has a little bit less variance. And then after growth equity, then you go into like that buyout private equity, right? And this is where I think a lot of the names like come to mind for people like KKR, Apollo, Carlyle, TPG, Blackstone, right? Like all those big dogs that like people read about in the journal constantly. And they're buying out entire companies, typically very mature companies that aren't growing as much. And they are typically buying out the entire company, often using debt, and then leveraging that to generate a return for their investors. So all of these are happening at like different stages of a company's life cycle. And all of them have slightly different strategies and return profiles. And I think all of them are quite important to having a diversified private market portfolio as an investor.
Yeah, absolutely. Loved how you put it across different stages of private equity. And like you just mentioned, that you should not really have all your eggs in one basket when it comes especially to the venture capital asset class. So for investors who want to invest, let's say on one fund into these different venture funds, then what do you think would be the ideal diversification rate for them? Let's say they want to deploy $100,000 into different venture capital funds, or basically in this asset class. Then how do you think they should divide up? Should they invest 5% in each firm that they invest in, or should they go more finer and maybe 2 to 3%, or maybe bigger than 10% or something like that?
Yeah, that's a great question. I'm gonna try to refrain from giving investment advice on the podcast, but what I will say is that I think, generally speaking, for people who don't have any access to alternatives, if you're getting into a diversified fund with a track record, it's generally better than having no stake in any fund at all, right? By investing in a fund with a track record, you're kind of immediately getting access to typically, dozens of companies that fund is investing in. So you're already in a diversified state. I think previously to what I said, I kind of encourage people to try to invest where possible along the life cycle, right? Venture, growth, buyouts, and making sure that you're trying to get as much exposure across that life cycle as you can. And the last thing that I'd say is that I think it's really important for people to keep in mind, regardless of where they're investing in private markets, that these investments are kind of, as I mentioned earlier, very different than public equities. They're typically not as liquid. You can't sell them as easily. They have a lumpy return profile. And what I mean by that is, like, you might go from year one to year two with the fund reporting like 3% returns, but that's because unless the company that they invest in takes another investment, sometimes they won't even mark their investment up, right? So you could go from year one to year two with like 2% returns, and then all of a sudden at year three, it could shoot up to like, 50% or something like that. So it's weird, and I think people should be aware of that when they go in. But also, because of this liquidity, people really shouldn't invest money into private equity or venture capital that they think there's any chance that they're going to need in the next 5-10 years, or the life cycle of the fund. And there are some interesting ways that people are thinking about solving that, but to be honest, they're all imperfect. And typically you don't get your full value as a customer, as an investor, when you do try to get liquidity out of these funds. So I think really, like, you shouldn't invest any money in these funds that you think you're going to need over the lifetime of the fund, which is really important. And that's why endowments, right, even though these returns are so good, like I said earlier, they're still only investing, maybe 15 to 20%, because they know that, and obviously there are outliers, but they recognize that it's a longer term investment. They can't get their money out whenever they need it, et cetera.
Yeah, absolutely. That's one more thing that people need to be aware of before investing in this asset class. Also, the past 2 years have been kind of bumpy for this asset class, in particular the venture capital industry, wherein the valuations are not going up anymore, and there are down rounds happening, and so it's kind of not what we used to see the years
Yeah.
before that, right? So how do you look that impacting this market right now and the investor interest it gets?
This is a really, really interesting topic, and I've been thinking about it for a while. And you said it perfectly, right? Like, you go 7 years back, the past 7 years, money was cheap. People, particularly buyout, could get debt for pennies on the dollar, or for nothing, basically. Go out and buy a company, and it's super easy to make the leverage buyout model work, right? VC, you just had multiples continuing to climb. Fundamentals could stay relatively flat, and all of a sudden you have a company that's way more valuable, right? And for listeners, what I mean by multiples is sort of the price that you pay for the company, right? So if a company has $1 million in revenue and they have a 5x multiple, you pay $5 million for the company. Well, if it has $1 million in revenue the next year, but because of markets, the multiple's gone to 6x, all of a sudden that company could be worth $6 million. And so you just had multiples climbing, you had low debt, and that's a very nice environment for private market investors typically. Obviously, that's changed, right? Prices for private companies have come down a lot. You have debt going up. And I think that makes it even more important than ever to be investing in funds that have track records, hopefully funds that have been through previous down cycles before. So like the most recent ones that come to mind, right, being 2008, 2001. And obviously it's history, it's difficult. You can't predict what's going to happen in the future, and I'm not going to do that. And history doesn't repeat itself, but it does rhyme, right? And when you look back at previous cycles of, what vintages performed best in private markets, it's 2001 and it's 2009 to 2010. Because at those points in time, right after the crashes, you had much lower prices for a lot of these assets. And these are long-term vehicles, right? So when these investors are looking at these products, it's not, hey, what is the market going to look like 1 year, 2 years from now? But really, like, what does this company's prospects look like 7 years from now? And the economy is going to be in a very different place in 2029 than it is in 2022. But I think to your point around, you know, pricing is very different, right? Multiples have come down. One thing that we look for when we're talking with general partners, and I think is really important, is do they have an operating team or a value creation team or whatever they choose to call it. This is actually the team that I was on when I was at General Atlantic. But basically, like, do these VC and PE funds have a team that isn't just about like deploying capital? Because I think deploying capital can become commoditized, but do they have a team that's, you know, built up of like former industry executives, consultants, operators, people who can help the company that they invest in, improve its supply chain efficiency, optimize its marketing strategy, develop data analytics, some really powerful tools that they can leverage, especially in the VC and growth stage, where a lot of these companies are less mature, right? And if you have, you know, an investor coming in who has, you know, 100 portfolio companies, they can leverage the fact that they have more economies of scale than their portfolio companies do to provide assistance on, like I said before, things like marketing, um, pricing, data science, supply chain, sales. So I think it's helpful to look at, do VC and PE funds try to add value to their companies in ways other than merely giving capital? A lot of funds claim to do that. Few funds actually do. And the ones that do, I think, have a definitive advantage.
Yeah, absolutely, I agree. And besides, I want to talk about OneFund. So, what's the status on OneFund right now? Is it already live? And are we already onboarding GPs and funds are being raised? And are we onboarding LPs on the side of individual retail investors? So, what's happening there?
Yeah. No, I love that you asked that question. I get so caught up, I think, sometimes like talking about the industry and stuff, I forget to talk about where we are. So we are in the process of closing our pre-seed round right now. I'll keep the details of that quiet for now, just because it's in the process of closing. But we'll have some exciting info to share on that soon. And then we're going to be launching our product. It probably will have launched by the time this podcast comes out, which is very exciting. We're doing a private launch with some of our early members before we do a broader launch. We have a bunch of great GPs that we've partnered with that we're really excited about, and it's been a really great process getting to this point. And yeah, so we're going to be in market very soon. It's very exciting. And if people want to learn more about what we're doing, they can go to our website, sign up for our newsletter, check out some of the, you know, educational material that we talked about earlier, kind of talking about the markets and all that stuff, at onefundinvestments.com.
Awesome. I'll make sure to put all those links in the show notes below, and so that our listeners can get there easily. And I believe that the product will be very much out by the time this episode is out. So the links will be there in the show notes. You can go check them out. And great, John. It was a pleasure hosting you, and I love the things that you're building and the insights that you shared overall in the industry and the product that you're building. Pretty amazing, and pretty pumped for what you're building at OneFund. Thank you so much for coming on, and happy journey ahead with OneFund.
Thanks,
Cheers.
Prashant.